one of the exciting things about the energy transition. We're in this moment where everybody is aware that it's going to take trillions of dollars of investments over the next few decades. And within that, there's going to be an investment in new technology, and anything new is inherently risky in the eyes of investors. And if we can use insurance as a financial instrument that can enable that investment to happen, then that's only a good thing. It's going to be an enormously powerful toolkit in the investor handbook.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Base Carbon. It's time to get serious on carbon. Learn more at basecarbon.com.
Welcome back to Carbon Frontiers 2024 on Smarter Markets. I'm Dave Greely, Chief Economist at Abex Technologies. Our guest today is Charlie Poole, Head of Carbon Insurance at Howden. We'll be discussing insurance and risk management at the intersection of finance, carbon, and technology. Hello, Charlie. Welcome to Smarter Markets.
Hi there. Thank you for having me.
Yeah, well, really glad to have you here today. I think we share a similar passion working at the intersection of finance, carbon, and technology, and a similar conviction that getting that intersection right is essential to making carbon markets successful. I know you currently work as the head of carbon insurance at Howden, an area that I think, insurance has a role in the carbon markets that many people don't think enough about. And I was hoping you could start us off today by telling us, first, what is carbon insurance and how does it work?
Yeah, sure. Well, I came at this having worked before in project finance, and my background there taught me a lot about all the different types of risks that are faced by investors in the carbon markets. And one of the things that I noticed, and I think lots of people in the carbon markets also notice, is that it's very hard, it's very complex, there's lots of different types of risks, and there's lots of not only opportunities for investments to go wrong, but also deals to go wrong. If you are going to be presenting an investment opportunity to an investment committee, it's likely that they're going to be overwhelmed by the sheer variety of different types of risks in this space. And as many of your listeners will well know, it's very easy for an investment committee to say no to something. So if there is a way of identifying risks, but also transferring those risks, which is exactly what insurance does, then we can open up the investment opportunity to a much wider universe of investors and also help accelerate the way that deals can be done. Because if there's a checklist that needs to be gone through and you're presenting to the investment committee, you'll have a bunch of risks which you can say, yes, I'm okay with, no, that doesn't work for me. And that could be the deal breaker, but if you can transfer that away, you can just move on. And so the way that we think about it at Howden is that insurance is kind of a force for good. It's an enabler. It allows you to open up investment opportunities to a wider audience and also allows them to do deals faster. And the combination of those two things can only increase the size of the carbon market.
And I think a lot of people don't pay enough attention to the fact that how much you need to de-risk a project before a committee or an investor will get comfortable with it. And I'm curious, are there certain types of risk that are kind of high on the list for investment committees, high on the list of risks they're not comfortable with? What are the ones that tend to disrupt the deals?
Well, first of all, every investor is going to have a different risk appetite, and some things will suit some investors more than others, and it'll be a mix for everyone. But the way we looked at this at Howden was we looked across the entire project lifecycle and identified the risks, and they change over time. So in the early stage, you have the sort of methodology or technology risks associated with the design stage. And then once it's built, there's the construction risk, and then it's up and running and it could be damaged. There could be problems with the monitoring, the reporting, the verification. Then you get in towards the later stage, you're into issuance, and there's trading risks and counterparty type risks. And when we look at all of those things, there's a whole range of different things. And what we find is they kind of get lumped into the project financing type risks, and then the sort of carbon specific type risks, particularly when it comes to getting through the process to issuance, and then also environmental, social, political type risks, of which particularly with the latter, there's many, because they tend to be, by they, I mean the carbon projects, they tend to be in emerging markets. They're very long term, and so political risk is very much a thing there. And then towards the end, we get into the more trading type risks around market counterparty, fraud and negligence, reputational. So there's these big, different, distinct areas. But if I was going to pick the areas where we get the most phone calls from, it would be around technology performance guarantees, particularly around high-end engineered type carbon removal credits. And then natural catastrophe, things that affect nature-based projects, things like drought, flooding, wildfire, this sort of thing. And then this sort of fraud and negligence, invalidation type risk, when you've bought some credits and it turns out that there's some negative media that reduces the value of those credits, shall we say, and there's insurance policies to protect against that.
The last one sounds very interesting, but first I want to come back to, I think a lot of us, we hear a lot of stories on the nature-based side of, well, if you're planting a forest or preserving a forest, what if it burns down? Because we hear more and more about wildfires. How do you structure an insurance product for that? And I'm curious, like, is the payoff in cash or kind of in kind? Do you get credits from somewhere else that you can use to fulfill any offtake agreements you have?
Okay, great question. So with nature-based projects, what we tend to use is a type of insurance called parametric insurance. This is unlike a traditional insurance, like an indemnity type insurance, where traditionally an event occurs, damage is reported, then a loss adjuster comes and assesses the damage, probably going to have a bit of an argument about what actually got damaged. This could go back and forth, and it could be months before the payout's actually sent to the insured. With parametric, the payout is linked to an event, and the word parametric comes from the word parameter. So you set the parameters and link the payout to an index. The index can be a natural catastrophe event with, say, a wildfire, or lack of rainfall, or too much rainfall, or too much wind. All of those are events that can be verified using some third-party source, typically satellite data. In the case of wildfires, the way that you would do that is by having a satellite monitor an area, and it can go down to extraordinary minute detail in terms of the geographical space that's covered. And you would have a payment based on the amount of area of land that got burnt down. And that payment would be triggered automatically. It's verified by the satellite, and the payout can be received by the insured within 24 hours. So it's very, very different from a traditional indemnity policy.
That's interesting. And often when I think about insurance policies, I think of like the insurance pool, like the idea that in the case of a wildfire, you have a rough sense of how many acres could be lost to wildfire in a year. You don't know who's going to be affected, so people can pool their risk together. But some of these others sounds like there's a big aggregate risk, which brings into the question, like, who's taking the other side of this risk transfer? Is it a pooling of risk amongst participants? Or are there other ways to offlay that risk on other investors, other sectors?
So there'll be a lead underwriter who will price the risk, and they will carry that risk, but will likely reinsure themselves. So it then becomes pooled. And I realized saying that I didn't fully answer your previous question because you asked about the payments in cash or payments in kind. Then, depending on who the underwriter is, depends on whether you would get paid out in cash or paid out in carbon credits. There are a couple of underwriters now who are paying out in carbon credits. Cash is probably a little bit simpler to get your head around, except for the only thing to note that with the insurance market is that insurers don't take market risk. And so the amount or the price paid for those carbon credits, the price that's going to be paid out, is set at the beginning of the policy, and the market might have moved in that time. But if you want to be paid in credits, that is becoming possible. There is a company called Kita who has just launched that. And there is a company in Switzerland called Carbon Pool who are launching next year, who are also going to be doing that. These are both underwriters who we work with, but the big issue there is fungibility. Getting paid out in the type of credits that you are satisfied meets the same sort of criteria, whether they're quality criteria or other, is the big question that they need to answer.
And I want to go back to the third type of insurance you were talking about, which sounded a little bit like a methodology insurance. Like if you are getting credits under a certain methodology and somehow that falls into disrepute. Correct me if I heard you wrong, but given what's happened in the carbon markets in 2023, I'm curious about how are you being approached to offer that sort of product, and what sort of product can you offer?
Yeah. Now we can get a little bit more nuanced about this because there is both a methodology product, which is the change in a methodology, which would lead to previous vintages losing value because maybe the technology has moved on, which would make those credits that were issued at some point in the past not as strong or deemed as high quality as the ones produced today under the new methodology. So you can insure against that. But the product that I think you were referring to is our invalidation insurance. And so what this means is really around a fraudulent or negligent event occurred typically by the project developer. So this is a type of insurance taken out by the buyer against the seller. But if it turns out that the seller, as I said, typically a project developer, had done something incorrect, and how that's defined is getting even more nuanced, but it basically means that they hadn't followed the PDD as stipulated. If it was found out that they'd, overstated the number of credits or hadn't followed a particular process the correct way, and that resulted in more credits being issued than perhaps should have been done, there is a policy that can kick in and protect the buyer from the loss of value of those credits that have been invalidated and could potentially be worthless now that this event has been brought to light.
That's pretty fascinating. I wanted to ask you, often when thinking about different instruments, insurance, financial products that transfer risk from one party to another, there's one that transferring risk helps people sleep better at night, so that has a good of on its own. But in terms of really, moving the needle, it's about once you're insured, once you have laid off some of the risk, you change the way you run your business. You change your behavior. You brought up one example of that. If the project's de-risked, the investment committee may vote for it to go forward, and then these projects happen. You're unlocking capital, you're unlocking investment. I'm curious, do you see these insurance products changing how people manage risk in the carbon markets and how they choose whether or not to invest?
Yeah, absolutely. I think this is the real power of insurance, something I didn't really appreciate until I joined this world. And I only joined 6 months ago, and having never worked in insurance before, never thought I'd work in insurance, to be honest about it. But what I've quickly learned is that the power of insurance is that it enables other things to happen. It allows, as I said, in that case, about bringing in more investors, widening the universe. It attracts capital, and by de-risking or enabling people to transfer some of those risks, it allows things to happen that wouldn't have happened otherwise. And I think this is one of the exciting things about the energy transition. We're in this moment where everybody is aware that it's going to take trillions of dollars of investments over the next few decades to move towards net zero or decarbonize or whatever it is, that term that we're using to get to this future state that we need to go towards. It's going to require the mobilization of enormous amounts of capital. And within that, there's going to be an investment in new technology, and anything new is inherently risky in the eyes of investors. And if we can use insurance as a financial instrument that can enable that investment to happen, then that's only a good thing. It's going to be an enormously powerful toolkit in the investor handbook.
And you've talked about many of the different types of insurance products that you're developing in the carbon markets. And I was curious, a lot of them sound very innovative. How many of them do you see as kind of taking insurance products that were developed in other markets and other use cases and bringing them into the carbon markets? And are there ones that you see as unique and needing to be developed kind of from greenfield for carbon?
Yeah, so day one joining at Howden, my first thing to do was to map out all the different types of risk associated with the carbon project, all those things we just talked about earlier. And then meeting with other heads of departments, like people from the head of M&A, from the head of real estate, and saying, look, these are the sort of risks that are associated with carbon. I'm here now setting up this new carbon related business, but I'm new to insurance. Can you tell me if there's anything here that looks familiar to you? And guess what? Pretty much every one of those risks already comparables out there. So all we were doing is really taking existing insurance products and tweaking them slightly for the carbon market. Real estate being a classic one. There's plenty of knowledge and expertise there around construction risk and property damage. The natural catastrophe team were the ones who sort of pioneered this parametric product I was talking about for the drought and flooding, wildfires, storm damage. The M&A team with the warranties and indemnities, the fraud and negligence product that I mentioned for invalidation insurance, that also came out from the M&A team. And so really what we were able to do from the moment I joined just 6 months ago to now was not reinvent the wheel. We already had these products. We just had to tweak them, and we already had the underwriters. So we have now got about 12 different products, insurance products for the carbon market, which is kind of incredible, really, because we're getting to that stage in a very short period of time where we can get to the vision of having that shopping list, the basket of options available for investors to be able to tick off all those risks. And I think the fact that there are so many different markets out there, the underwriters who are willing and enthusiastic about getting into this market, is really, really positive. Where it can be slightly different, a great example is in political risk. So we had conversations with clients through the summer who said that they were a little bit worried about countries or governments intervening and doing something like Zimbabwe did at one end of the spectrum, where they effectively are putting, or said they will, put a tax on revenues generated from carbon credits. And then at the other end, you've got countries like Indonesia that paused the sale of carbon credits for a period of time. Clients were worried about what type of political risk they could be covering. And we have a whole political risk team of 50 odd people around the world at Howden. And I spoke to them and they said, well, in the first instance, they didn't really need to worry about the carbon aspect of it, which kind of blew my mind. They said, well, you tell us that Zimbabwe has interfered, we can tell you there's a track record there. It's almost predictable. But then as we started to go deeper into that, we looked at all the different government interventions, and we spoke to lots of clients. And this is kind of the way that you build a new insurance product. You speak to the clients on one side and you speak to the underwriters on the other, and you've kind of got to meet somewhere in the middle. It turned out that actually the risk that we kept on hearing over and over again was around the revocation of letters of approval and the corresponding adjustments that those LOAs might lead to. And that's very much a carbon thing. That's quite different. And so we had to go to the political risk team and explain exactly what a corresponding adjustment is, what a letter of approval is, how a host country goes through the process of writing a letter of approval and the infrastructure behind that, the government infrastructure, the legislation, call it Article 6 preparedness, if you will. That sort of level of understanding is something that's completely new to the political risk markets, but in many ways, we're getting there much quicker than I ever imagined we would, because this, again, isn't that unique. Okay, sure, the carbon angle is fairly unique, but the angle of setting up the apparatus of government and legislation and all those sorts of things, and assessing whether a piece of paper is worth the ink on it, these are sort of things that the political risk team does day in, day out.
And I imagine in the past, they've looked at the nationalization of resources that happens sometimes in oil or mining, and maybe there's some precedents there that can help them calibrate their approach.
That's exactly right. And there's a whole legal framework of language behind that.
Yeah, and I wanted to come back to this idea. You had brought up that there's a lot of enthusiasm, I believe you said, amongst underwriters. And of course, that's so important because you have to get the balance between the demand from the clients and the supply, in a sense, from the underwriters. And if there's not enough underwriters who want to participate, I assume that means you can end up with very expensive insurance products. So I wanted to ask you, where do you see the enthusiasm among the underwriters coming from? What's driving it?
There's several parts to that. I think there's the market opportunity. We can't deny that. There's obviously, if you believe in climate change, which most people do nowadays, then you are going to believe that this is possibly one of the biggest events that is going to happen to all mankind over the course of your lifetime. And what industry is better positioned to play a role in that transition than insurance, which is in the business of risk management? And I think most underwriters accept that because their industry is in the business of risk management, there is definitely a business opportunity there. What that opportunity looks like is yet to become clear, is yet to be defined. But I think there's definitely the sense that there's a business opportunity there. The second bit is that it's becoming more and more of a requirement from like an ESG perspective. There is much more enthusiasm from management level, from top down, for looking at things from an ESG lens, and potentially they may take more risk for less reward at this stage, just to understand exactly how the market's going to play out, but also because it's part of perception as doing good. And I think the third bit is more on a personal note. I think everybody wants to know how can they do their part. And I think, I definitely believe this when I've got 3 young children. When they ask me about climate change, I know that one day there could be like a conversation a bit like how we had with our grandparents when they were in the war and what did they do. Our children and grandchildren are going to ask, like, what did we do in the fight against climate change? And I think the enthusiasm from people I speak to, just generally, not just within insurance, but my network is fairly biased towards anything to do with climate. Everybody is wanting to help, to do one's best, is motivated, and I think that part of it is very exciting.
Absolutely. So you have the enthusiasm. I just wanted to ask you a quick question on the challenges. I imagine, whereas you've said a lot of these products have existed in other forms and other places, so like there are approaches that can be transferable into carbon. I imagine the assessing the probabilities, the distribution of loss that underwriters would have to think about in terms of these products, that would seem like that could be a challenge. Is that one of the bigger challenges underwriters face, or where do you see the challenges facing underwriters?
I think for sure that's going to be a big challenge for them. That's not so much the part that we as brokers get involved with. So I'm not sure I would really want to comment on exactly how they feel about that, but that's clearly the business model, and so that's going to be a big piece of the puzzle. I think from our side, it's really around structuring the right policy for the client, and I think the challenge over the next year or two as we build out this nascent market is to really understand the client's needs, to listen to them, work out where they perceive the risks, work with them to make sure that those really are the right risks to be concerned about, and then work with them and the underwriters to create the best type of product to cover those risks. And what best means is slightly subjective, but it's going to be a combination of the right level of protection for the right price. And I think if we can do that and find the right protection at the right price, we will achieve our goal of de-risking things for the investors and widening the market and opening it up for everyone.
And as you said, you're building out this nascent business in carbon insurance. You're drawing on your experience and your network in climate and in carbon. And I know before Howden, you were at Toucan. And I was curious, what do you see as the role of technology in the carbon markets? And is there something you learned at Toucan that you believe is important to the work that you're doing now?
I mean, I'm a Web3 maximalist in the sense that I still believe, although it got off to a fairly fiery start with Toucan and KlimaDAO and the whole sort of explosion onto the scene a couple of years ago. This time 2 years ago, we were really sort of in the thick of it. I maybe jumped the gun a little bit, but I do 100% believe that eventually technology will play a huge role in anything to do with the carbon markets. I think the underlying premise and the vision of Toucan Protocol was just absolutely mind-blowing. The idea of digitizing a carbon credit, putting it on a blockchain, and having all the data associated with an underlying project, all the monitoring, reporting, verification information, all the geospatial data, all those sort of things is one part of it. But then the idea of it being programmable is the bit that I found mind-blowing. The fact that now, if you want to buy carbon credits, it's not an easy thing to do for an average person, unless you want to get ripped off and buy them through, like just buy a couple of tons to offset your Christmas or something through a retail broker. That's kind of different. But if you want to directly invest in an underlying project and buy specifically from one project, that is not a particularly easy thing to do, setting up different accounts, particularly the registry accounts, and usually involves a great amount of time and a great amount of money and multiple different third parties and intermediaries. But with the digitization and the programmability, you can literally write an if this then that type statement, like if I switch my lights off, buy a carbon credit, and link an event in code to the purchase of a carbon credit. Now, that might sound a little bit out there, but we had a trucking company that was fitting this like device on the exhaust pipes to their trucks that was monitoring carbon emissions in real time from their fleet, sending that data back to its HQ at the factory and purchasing carbon credits at the same time. So there was a stream of data going one way and a stream of payments going the other. And I think taking out any human interaction like that is just like an incredible use of the technology. And I think this is where it links into where we are at Howden. I was amazed on my first day there to overhear someone on the desk behind me talking to a company called dClimate, which I knew from Toucan, and I just assumed was just a Web3, a company just operating in the Web3 space, only serving other Web3 companies. I didn't realize they'd be talking to a company like Howden. But actually, this company, dClimate, was providing the data for underwriters, it's climate data, for underwriters to link policies to. And all this data is kept on a blockchain. And that, which when I think about it, is actually, that's an obvious home for that sort of data. And so maybe it's not that surprising that Howden would be using that data. But I think the ability for self-executing smart contracts, which is really what is so phenomenal around Web3, I see that playing a big role in insurance. And we're speaking to a lot of the same companies that I spoke to at Toucan. And, when I mentioned earlier the parametric insurance, we have an example of a mangrove project in India where the payouts link to the severity of a storm. That storm is verified by satellite data coming from NASA and ESA, the European Space Agency. And if the winds reach a certain speed, it hits a certain categorization of storm and triggers a certain type of payment. And I think the ability to write these contracts in code so that there are no human interactions and the payments just occur, I think that's the future. I can see that happening in the not too distant future.
And thinking about the future, I think it's worth our audience knowing that you've been deeply involved in carbon in the past, even before Toucan. You're one of the veterans from Carbon Markets 1.0 in the 2000s when you helped found the carbon desk at JP Morgan. And I'm curious, clearly there are more tools that are available now than were available then, and more tools being developed, the Web3 tools in particular that you discussed. I'm curious, though, are there lessons that you learned then that you think are important now? Or is it that we have technology that wasn't available then? What are you carrying forward from that period in your career to try to make carbon markets work better this time?
Yeah, I think in many ways things were a lot simpler then. We were operating in the compliance markets. The beauty of the CDM, for all its flaws, was that carbon was commoditized. And so a carbon credit was a carbon credit, which made things a lot easier. You could have a whole derivatives market based on that. The fungibility allowed a futures market, and things were just easier to do. And you didn't have these problems around the quality of a type of carbon credit. And of course, there was different varying degrees of quality underlying it, but that wasn't at the credit level. But you didn't have these issues around integrity and quality that you have today in the voluntary carbon markets. And I think the one thing that surprised me, that the carbon markets almost went on pause for a decade, from 2010 to 20, and sort of suddenly reappeared and blown up in no part by Toucan, my old company. But what I was surprised to see is that we're having a lot of the same conversations over and over again. And these conversations have dragged on for years, decades now. And we're running out of time. And I'm a massive believer in the power of market-based mechanisms. I mean, carbon trading is a market-based mechanism in its sense, but in its own right, as opposed to, say, a carbon tax. But it's because we're running out of time, the impetus is now on the markets to try and drive change quicker. And I think this is also why I jumped the ship across to the world of insurance, is because I see how insurance could play a role of raising the bar and increasing quality if you make it a market-based mechanism, that by putting the impetus on investors to demand certain criteria out of project developers and have those criteria stipulated in actual legal contracts, then you can raise the bar on quality in a market-driven way rather than just asking people to adhere to principles. And I think that change is coming. And I think the market reached a tough point. It's not been a good time in carbon. The last 18 months or so have been very tough. The market has had plenty of negative media, but you think it can't get any worse, and then it does. It's got to this stage now where we need to really up our game a bit. I think I'm really bullish about this year. I think this is exactly the same sort of sense we had in 2009 after the financial crisis. And that was by far the best year of my career. I mean, I was lucky then. I was at JP Morgan, probably the best place I could possibly be at the best bank. We were kind of famously the only bank at the time who'd remained profitable through the downturn. And 2009, everybody was panicking, and we went shopping, and it was phenomenal. And I think we'll probably see that now if the big banks haven't really played much of a role in this latest wave of carbon markets, but they all know that this climate change thing is a thing, and carbon is a thing. Carbon markets are our way, like best way really, at decarbonizing. And so the banks are going to play some role. The other sort of major players will be gearing up as well to go shopping. I think that, things will be cheap right now. There'll be a period of consolidation. Everybody must be gearing up to go through some sort of M&A frenzy. Well, I'm hoping they will. That could kickstart the market again and get things moving along. And I have a lot of these conversations every day. We speak to serious people at serious institutions. Got a network going back almost 20 years now in carbon. There's a lot of very interesting people having very interesting conversations about getting things moving. So I think I'm very bullish for 2024.
I like your optimism, and I like even more that it's from experience and from a lot of conversations with people who are moving things forward. I really appreciate this conversation with you. As we wrap up, I just wanted to ask you, one more question, because you've spent so much time at that intersection of technology, finance, and carbon. And I think, like us and our audience, you're very interested in figuring out ways to make these markets work, that market solutions are going to be among the solutions we need if we're going to deal with climate change effectively. And so I'm curious, obviously you voted with your feet and your career by working in insurance at Howden. But when you kind of look at this intersection of technology, finance, carbon, in addition to insurance, are there other things that excite you about what we'll be able to do next and hopefully help that push that you see coming in 2024?
Yeah, I think the exciting thing about the technology is just the pace of change and how things are coming in so quickly. I mentioned already around MRV with the monitoring, reporting, verification, using different data sources like satellites, IoT sensors on the ground. The way that that's being used is incredibly important because it's raising the bar on integrity of the carbon credits, because it's been proven to be used by the technology. You can see and use data to know that an event occurred. And that links into another really exciting aspect of it, which is the digitization of the methodologies themselves. I think it's very cool what some companies are doing so that if an event occurs, it can move the process along the methodology towards issuance. So you no longer have to rely on so many human interactions at the standards, which are, quite frankly, becoming bottlenecks, not through any fault of their own, just that they can't simply scale quickly enough. So if you can take a load of work away from the standard and give it to a technology or a process that's been digitized, I think that aspect of it will be really, really exciting. I think the final part of that is, again, I'm going to link this to insurance, is that who knows what other products could be spun out of that based on new technology. In the insurance world, we look to different data sources to create indexes or to have better insights, to create pricing models, these sort of things. We just don't know what's coming up next, but we know from history that every time there's more information available to people, innovation can occur and new products will be built and be launched. Some might work, some might not, but that's how we move forward. And I think the ubiquity of technology and the way it interweaves with the carbon market will be something to really watch in the future.
Thanks again to Charlie Poole, Head of Carbon Insurance at Howden. We hope you enjoyed the episode. Join us next week as we continue our series, Carbon Frontiers 2024. We hope you'll join us.
This episode is presented by Base Carbon, a financier of projects involved primarily in the global voluntary carbon markets. Base Carbon endeavours to be the preferred carbon project partner in providing capital and management resources to carbon removal and abatement projects globally, and where appropriate, will utilise technologies within the evolving environmental industries to enhance efficiencies, commercial credibility, and trading transparency. For more information, visit basecarbon.com. Base Carbon, sensible carbon investing. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.